Hey, thanks for joining me today. We're going to talk about the mortgage payment, PITI plus HOA, maybe Mello-Roos. We're kind of digging into all of that stuff. PITI is principal, interest, taxes, and insurance. The first two, PI, principal and interest, those are at the very beginning of the loan. You're paying off a very little amount of principal, which is coming off the owed amount, and a lot of interest. As the payments go on and on and on, the amount of interest paid goes down and the amount of principal paid from each payment goes up. Now, what's interesting is the principal and interest part of your payment stays the same for 360 months. It is the bulk of your mortgage payment now, especially right here in the beginning, but 30 years down the road, we'll see what taxes and insurance costs are. But the taxes and insurance part of your payment will change year over year as you get a new insurance policy every year. The cost of that insurance has been just going up little bits by little bits every year. So the taxes part here in California, we have Prop 13. It's under attack right now, but here in California, the taxes do move up. They just move up pretty slowly. They take the amount of taxes. So if I have a $10,000 tax bill, they can only go up by like 2% per year. So that $10,000 tax bill would be $10,200 next year, and then $10,400 and $20 or $2 the next year. So it goes up very slowly, even though the neighborhood might start selling for a lot more. All right, so let's jump into it. Let's get off of here and go into here. So the first place that we start is our favorite home search website. Mine is homes.com. So let's go and say, let's do San Diego. Let's say I'm stationed 32nd Street on a ship, and I want to get a 2-bedroom condominium in San Diego. So let's go 2 beds, condominium, and search. All right, so we know that the 32nd Street base is here, right? So we've got the 15 freeway goes all the way up into Temecula and into Riverside, but through Escondido. So Escondido all the way down, straight in down. And let's say that we want to stay around that 15. So let's go ahead and clear this boundary. See if we can make, yeah. All right. So let's go, we'll live anywhere along the 15. That way we know that we're going to get up in the morning, get ready, get on the freeway pretty quickly, and jump right in. So let's go with price, low to high. All right, so $345 will get us something, a 2-bedroom up here in Escondido. That would make about a 45-minute drive to work. So let's see if there's anything closer first. These are really nice areas, Rancho Penasquitos, especially if you have some school-aged kids. There's a good one. It even tells us where did that one go? Here we go. It says it's VA approved and turnkey ready condition. All right, so here's a good one for our VA members. Now I'm going to open another tab, and I'm going to go to ChatGPT. Come back to my search website and copy the address and price of the home. And what I'm going to ask ChatGPT to do is please estimate the property tax and insurance cost for me if I were to buy this home at this price. All right, I'm going to take out this 20K price drop because that's not relevant to what they're working on here. Okay, so I'm getting this information, from ChatGPT. I've been using ChatGPT for this for a few months now, and I haven't had anybody come back and say that it was grossly off. So for the sake of getting good news at the end and not bad news, instead of using your lower end, 5150 to 5360, let's use the higher end. So let's go ahead and gross that up to $5,400. So we're going to take note of that. $5,400 for insurance or for property tax. Let's see how much insurance is going to be, and that's per year, right? And it shows you right here the monthly equivalent is this, and that'll come up again later. So we have $1,600 for our insurance. So $1,600. Now it's time to talk about the funding fee. So the VA funding fee, when you do the search, make sure that you're looking for va.gov before you go and click. If you're clicking on a .com or a .org, you're more than likely going to hear from a bunch of people that are looking to take advantage of us, in veterans in researching, finding, buying a home. All right, so about the VA funding fee, you can read about it. Here's all of the ifs, ands, and buts about it. If you do have a qualifying service-related disability, you'll find that your funding fee is actually zero. Obviously, for you guys that are still on active duty, just like me, when I was on active duty, we don't have a disability rating, so we just pay this thing. There's two things to point out, right? In the chart, you see first use, after first use, right? So now you have a less than 5% down payment, a 5% or more, or a 10% or more, different brackets, right? And those three brackets are the same three brackets as your after first use, and your 5% and 10% or more funding fees are the same for first use and subsequent uses. But this is where it gets heavy, is that this 2.15% on your first time that you buy your first home, right? My first home I bought for $77,000. The second home I bought for $270,000. So you can see why I really didn't notice it on this one, but then on this one I should have noticed it, and I didn't. I didn't even find out about the funding fee, even though I was paying them every time until the fourth place that I bought. So that was pretty interesting on that. Now, 2.15%, it can be paid as a closing cost. I wouldn't suggest it because you already have to have 2.5% to 3% in closing costs to expect anyway to be out-of-pocket expense. That out-of-pocket expense can be negotiated to be paid for by the seller. It can also be worked out with your lender. If you're not at the top of your budget, you can actually take a higher interest rate, and the lender will start paying your closing costs for taking that higher interest rate. And then, of course, when it comes time for the interest rates to be better, you can do a refinance and what's called a VA IRRRL, and you can actually go Control F IRRRL, and there it is right there. It's only a 0.5% funding fee, and they do that because they want to keep the cost of the IRRRL as low as possible, because it's just a refinance to reduce your interest rate. So it's an interest rate reduction refinance loan, IRRRL. All right, so back to the chart. This 2.15% is going to get added to your loan amount, right? So is the 1.5, 1.25, 3.3, 1.5, or 1.25, whichever is applicable. It'll be added to your loan amount unless you tell them that you want to pay that out of pocket. Now, my favorite mortgage calculator is going to be Carl's mortgage calculator. It's going to be on drcalculator.com. I really enjoy this calculator because you have the summary here. You know, I already have these inputs from the last time I used it. You got the summary here, the payments there, the monthly here, the annual there, and here's the graphs that show you the amortization. So the red would be how much of your monthly payment is going to interest, and it's going down over time, and how much is coming off of the owed amount, which is principal, and it's going up over time. All right, so let's go ahead and start filling this in for this property. So if we are buying this property for $429,000, and we have to factor in our funding fee, so let's go ahead and pull up a calculator. So we're going to go $429,000. Now, 2.15% in a decimal is 0.0215. So to add 2.25% or 2.15%, sorry, to this loan amount, it's easy. You put in your purchase price and you multiply it, so times 1.0215. And that's going to be our borrowed amount with the funding fee included. All right. Same thing, 1.033 will add 3.3%, 1.015 will add 1.5, and 1.0125 will add 1.25%. All right, so I copied that number off of the calculator and I pasted it into the loan data. Now let's go back to ChatGPT and get our numbers here is 5,400 and 1,600. So I'm going to go, this is loan data. I'm using 5.5% because my favorite lender, Derek, told me that that's what a well-performing VA loan should look like right now if it's less than $830,000 borrowed. So 30 years because that's the most popular length of a loan. And insurance, let's see. Oh, we already had 1,600 for the last workup. Let's go 5,400 for taxes. And now let's look at the summary and say, okay, so principal and interest is $2,488,000. Now that number can be moved here if you get a lower interest rate. You saw it go down to 2,352. If you sign on for the higher interest rate for the lender to pay your closing costs or some of your closing costs, it goes up, right? So let's get it back to that 5.5%. Good. Now, expenses, again, if there's an HOA, which this one has it, we'll add it in there here in a minute. But before that, I wanted to let you know that the expenses right now that we're calculating is insurance and property taxes, right? So PITI, principal, interest, taxes, and insurance. So principal and interest, $2,488. Taxes and insurance, $583. Total payment, $3,071.52. That's to the mortgage company, and that pays those four things: principal, how much comes off my owed amount; interest, based on what I signed on for, how much is the lender and lending institutions making from my borrow, right? Taxes, how much do I owe to the government for taking care of the community around me and renting my land, and insurance, how much is it going to cost me to insure the property. Now, with this being an HOA, in an HOA and a condominium, it's most likely walls in on the insurance, so your insurance rate's a little lower. If you buy a single family home here in San Diego, you should expect it to be about $3,000 to $4,000 a month, or a year. Sorry, not a month, a year. All right, so now we got to go back and do the HOA to see what is our total liability going to be here. So HOA fee, 605. All right, so then we're going to go to 605. And now we can see that the total monthly liability for this 2-bedroom condominium here in San Diego, bought with zero down, VA loan, 5.5%, 30 years, with insurance being $1,600 and taxes being $5,400, would end up costing us about $3,676.52 per month. So about $3,700. Now, how much can you rent a 2-bedroom place for? Now, in order to really understand, rental rates do change from zip code to zip code here, and 92129 is a very desirable zip code, especially when you look at like the performance of the schools and the parks that the sports are played in for the children. It's a very, very nice zip code to consider if you're raising kids. All right, so next thing that we're going to look up is homes.com. Again, we're going to go to the rental part. We're going to go for rent. And in 92129. All right. Now, in 92129, let's be apples to apples here. This is a condominium that's 2 bedrooms and 1 bath, not 1.5. So we can go, this is why I like Homes filters better, because I can go exactly 1 bath right there. Right? It doesn't say 1 plus. If I wanted to search 1 and 2 and 3 bathrooms, boom, I can do that. But I can also do just 1. So we're going to go 2 beds, 1 bath. And we're going to see that we've got, looks like apartment complex, because apartment complexes usually advertise that they have 1, 2, and 3 bedrooms, right? Look here, studio to 3 bedrooms. That's another apartment. Another apartment. Nope, there's a condo for rent right there. $31.50 a month for a condo for rent. $34.20 a month for a condo for rent. So let's pretend that this guy's asking too much and this guy's asking just enough, right? So $31.50 a month and $3,700 a month is a $550 difference. So it looks like in this particular neighborhood, if I can buy this property with zero down, I can rent it out for about $3,000 a month, and it'll cost me about $3,700 a month. So let's just use the 700 as the barometer. Now, if I'm going to go live in it, that's fine. I just have to acknowledge it's going to cost me a little bit more. I could rent it for a little bit less. But at the end of the day, if they have really good property management going on those properties, if we're at $3,150 already and I sign that lease, next year I should expect that it's going to be going up to $3,300, and then the next year $3,470, and the next year, oh look, the same almost as the monthly liability is to buy it. All right, so you're going to pay out of pocket more to own it than you are to rent it for the first years, right? How many years is that going to be out of pocket? It's entirely up to you, and it's case by case. It's entirely up to you to do this and figure that out, right? Now, here's another thing that I like to check is if you're in a part of your life where you can take roommates, you can actually make it make sense by going to roomies.com, and people actually put up like personal ads. So if I go here and say San Diego, California, unfortunately, you can't do this one by zip code, but you can see that we can say we want to go roomies only. So how much are people willing to pay? This is literally people posting themselves saying, I'll pay $1,800 for the two of us to become your roommates. Fair deal. $900 for just Alaska to be your roommate. Disha's offering $1,500 to be your roommate. Elisa is $900. Dennis is $1,500. Mariah is $950. Odette is $1,250. Right? So like all these people are looking for places to stay, and they don't necessarily want to go sign on for their own studio, their own apartment, all of that stuff. So you can measure out that $1,000 a month per room is pretty reliable. So if you think about it like this, if you're a single, sailor, and you can make this purchase of this property right here, 10472 Caminito Rimini, we already know it's in a VA approved community. Give me a call, because you can take on a roommate for, looks like $900 all the way up to $1,500 to take on that roommate, and that would make it to where you're spending less than it would cost to rent it by yourself, right? And they can actually start contributing to your economy, which you use your economy to service this debt. Would a 2-bedroom be a good one to move out of and then rent each room out? Probably not. When I look at those condos in that zip code renting for the $3,150 and $3,400, each roommate would have to spend $1,800 to be your roommate. So maybe two couples at $1,800 per couple could make it make sense that you would rent it out by the room, but it's a condominium, so the parking spots are probably limited. Also, take that into consideration. All right, so anyway, good resources here. Let's see what else I've got here. Oh yeah, let's go through the mortgage calculator. Let me show you the really fun stuff. All right, so we went over this annual stuff, right? So we can see if it started in 2026, it's paid off in 2056, right? Now I want to play with this extras tab right here. So we identified that it would be a negative cash flow for the first 2 years, and then even cash flow for that third year. Now I want to talk about months 37 and beyond, right? So 37 to 48, let's say that that's a break-even year also. But when it comes to months 49 to 60, let's say that we're collecting enough of a cash flow that we can afford to send an extra $50 that month, and then the next year, or for that year, each month, $50 each month for that year. And then let's say that from here on out, we're going to raise the rent by $100 per month every single year. So, and we're going to take that $100 a month and we're going to apply it to the owed amount. So I'm going to go $150 for that year, $250. So you see what I'm doing here. And as you play with this, you'll get faster and faster at it. So I'm just wondering, when would this property get paid off when I'm sending the mortgage company all of this extra money every single month to apply to the principal balance, right? So right now we're at that 20-year mark. I think we should check to see. So if we go back and say annual, are we still at 2046? Oh, look, that was perfect. So doing that pays the property off around the 20-year mark, right? So get your orders here, buy something like that, live in it for the 3, 4, 5 years that you're here, turn it into a rental, take your extra cash flow, and apply it to your principal. Raise your rental rate every single year that you own it, and every single year that somebody is, especially when somebody's going to renew their lease, you always raise their rate. So raising the rates and applying that raise by applying it to the principal, you paid this property off in 20 years. You know, if I bought this property right now and my wife and I just moved into it and our kids are you know, they're of adult age almost. My son is, my daughter is almost. So let's say that we bought it and moved into it to downsize and lived in it for 5 years or 3 years and then moved out and then started on this schedule. By the age of 65, this thing is paid off for us, right? So also in 20 years, we raised the rents by that $100 a month, right? So let's go back to the extras and really acknowledge how much are we renting this thing for. So we started off renting it for $31.50, right? And now it's $31.50 plus this, so $4,700. So $4,700. Is that about right? Let's see with the calculator. If I go 3150 times 1.05, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Wow, raising 5% per year for 20 years makes this an $8,000 rental. So I think we can definitely assume that we can afford to rent it out for $4,700 20 years from now and get this plan done this way. So when we're researching all of this, let's also go to the 4,700. Oh yeah. So 4,700. Let's say that our property tax bill, it had to go up by 2% per year no matter what, right? So we can kind of project that too. So $5,400. So get your calculator. $5,400 times 1.02. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. All right, so that's $8,000 a year. Now if we divide that by 12, we're looking at 700. So now instead of 4,700 and it being the cash flow, now we're at 4,000 being the cash flow. And let's say that insurance goes up by that 2% also. Well, I don't know, inflation, right? So let's say insurance goes up by 3.5%. So let's go times 1.03 half. All right, so we're at about another 300 there. Okay, so who wants a $3,700 a month cash flow, right? 20 years from now, that's what this thing is. The last point that I want to make here is that every single person in America is pretty comfortable paying rent that's about 1/3 of their income. So if you can manage to collect 4 properties and get all 4 of them paid off, you're living in one, and then you're collecting the rents from the other 3, and you're paying for property taxes and insurance for those 4 properties, right? So let's say that you have 1/3 of somebody's income, 1/3 of somebody's income, and 1/3 of somebody's income. So I understand that all 3 of these households are going to be relevant to the size of the property. So if you own four homes and you're renting 3 luxury homes, you should expect to collect 1 luxury home's household income per month in rent collected from those 3, right? If you have 3 lower end properties, 1 bedroom, 2 bedroom, starter homes, places for people to downsize or just get out of the parents' house kind of properties, right? You're going to have 3/3 of lower income households. So you can actually archetype what kind of retirement you can expect to have by just collecting the properties and how many of those properties based on how many of those incomes do you want. So you're thinking like, hey, Danny, we don't know that it's going to be $4,700, 20 years from now. Actually, the 5% raise makes it $8,000 a month. If inflation keeps going the way that it is, and rents keep raising the way that the way that they've tracked for the last 20 or 30 years, they keep going that way, it will be $8,000 a month to rent that 2-bedroom. So do you see why it's like super important that you at least buy one property? And I don't care where that property is. You should care where that property is, because if you're only going to own one property, that is the property that you move into or that you live off of the income from in later in life when it's paid off, right? And I know that my concept that I'm talking about right here is the almost the polar opposite side of investing in real estate when you look at like Pace Morby and Grant Cardone. I'm not sure that Pace Morby even holds residential property. I don't even think that he wants to hold it. I think he's more of an apartment guy. I know that Grant Cardone owns hundreds of condominiums, and he's okay with it. But Grant Cardone owns $990 million worth of real estate here in America, and he owes $770 million in mortgages and loans on that debt. And that's what I can see on public record. So I don't even know what kind of private loans he has out with other people. And I hope one of those people doesn't have like, $300 million outlaid with him and see this and be like, what, you're over leveraged. So hopefully I don't make a mess for Grant Cardone, because he'll probably send his lawyers, pit bulls, after me, and it won't be pleasant for me. But my concept is manageable. You pick up one property at a time. You buy properties that you like. You buy properties that you would like to live in. And if you're going to spread them out in the United States, spread them out in places that you would like to live. Buy one where your in-laws are. Buy one where your best friend from the service is, right? Buy one where you grew up. Buy one where you live now, right? Just buy when you can, what you can, when you can, where you can, and start archetyping your retirement based on those. Now you're thinking, well, can't I do better in the stock market? And I'm thinking, well, maybe, right? Like, all of it's speculative. Every one of it is speculative. But in the stock market, you own a piece of a company that you have no influence and no responsibility and no influence on, right? When you buy property, you have influence on it. So you might find yourself in a way that you bought a 2-bedroom, 2-bathroom cottage, or 2-bedroom, 1-bathroom cottage that was built in 1940 something on 1.5 acres. And one day you might turn that into a 8, 12, 16 unit apartment building, right? And maybe community. You might put another couple of 2-bedroom, 1-bathroom cottages on there to keep the aesthetics of the neighborhood right, and that's what it called for. And run them as Airbnbs, run them as rentals, run them as a community. Invite your family to come live in there, right? Just dream on it. Buy property that you believe in, and then use the concept of letting other people borrow that property for long enough to get it paid off. And then once it's paid off, you can use whichever one you want, and you can have the others generating income, monthly income, for you to retire on. So I hope this helps. I hope you get a lot of value out of it. Thanks for sticking with me. A 30-minute video is a big one for me. All right, guys. Peace out.